Welcome to this explainer. Today, we're decoding a massive, kind of invisible force in the financial markets based on some incredibly fascinating source material. We're going to break down exactly how you can pass those notoriously brutal prop firm challenges by mastering the actual mechanics that move the markets. Let's get right into it.
So let's kick things off with a pretty painful question, one that literally frustrates retail traders every single day. Have you ever mapped out a beautifully planned trade, parked your stop loss at a totally logical level, only to get wicked out by like a single pip, and then you just have to watch the market absolutely rocket in your predicted direction? Yeah, it feels super personal, right? Well, spoiler alert, it's not. It's purely structural.
The answer to all that frustration comes down to liquidity. Basically, think of liquidity as specific, obvious areas on a chart, like those glaring swing highs or lows where millions of retail traders have bunched up their stop losses. The market doesn't avoid these zones, it actively hunts them. Why? Because all those stop losses act as the literal fuel, the trading volume, that the market absolutely needs to keep its overall trend going. Okay, here's our quick blueprint for today's explainer. Number 1, we're decoding market liquidity. Number 2, we'll map out the 3 specific liquidity types. 3, we'll add in crucial trade confluences. And finally, number 4, we are going to walk through executing the absolute perfect setup.
Section 1. Decoding market liquidity, the stop-loss hunt. Understanding this hunt is genuinely the foundation of professional trading. Here's the thing, markets absolutely have to take out early participants to accumulate enough orders before pushing a trend higher or lower. Large financial institutions can't just slap a buy button on a massive order without sending the price to the moon, right? They need sellers to buy from. And where do they find thousands of willing sellers? Sitting right there in the clustered sell stop losses of early retail buyers. The market deliberately drops to trigger those stops, absorbs that liquidity, and boom, fuels the real move upward.
Moving right along to Section 2, the 3 liquidity types, mapping the chart. So this invisible force of liquidity hunting actually builds into highly recognizable visual patterns that you can map out on literally any chart. It pretty much always shows up in one of 3 specific structural forms: swing liquidity, trendline liquidity, and range liquidity. Let's just break these down one by one.
First up, we've got swing liquidity. This is definitely the most common and probably the easiest to spot. We're looking for a sweep of a single major high or a major low. So picture an uptrend. The market will suddenly abruptly drop to take out a really obvious previous swing low. That quick dip triggers all the stop losses just sitting under it. Once those stops are swept and the big players grab that liquidity, the real continuation to the upside finally kicks in.
Next is trendline liquidity. You know how textbooks teach retail traders to draw those nice ascending trend lines under higher lows and trail their stops right beneath that line? Well, that creates a massive, sloping buffet of liquidity. Eventually, the market's going to drop right through that trend line, sweeping out all those continuous higher lows in one fell swoop. Everyone gets stopped out at the exact same time, and then the market just casually resumes its uptrend. And finally, we have range liquidity. When the market is just chopping around sideways in consolidation, traders love trying to buy the support and sell the resistance. What happens? The market will often just spike below that support line, totally faking out the early buyers and hitting their stops, or spike above the resistance, taking out the early sellers. It's essentially sweeping the boundaries of the range to grab that liquidity before sharply reversing into the direction it actually wanted to go all along. All right, on to Section 3. Adding crucial trade confluences, the rules of engagement. Now, just knowing where liquidity sits is not enough. If you try to trade every single sweep, you're absolutely going to get burned. To filter out the bad setups, we have to combine these liquidity sweeps with 4 super strict structural filters. We need a really clear market structure, like consecutive higher highs and higher lows on the 4-hour time frame. We need the liquidity to be in the right part of the move. We definitely have to use premium and discount pricing, and finally, look for supply and demand shifts. Together, these filters basically perfectly time exactly when a market pullback is over and the bottom is genuinely locked in. You really want to pay close attention to this rule. While you're confirming that bullish 4-hour market structure, it is incredibly crucial that you only target liquidity levels located within the previous upward impulse move. The impulse is that big, strong, aggressive push-up, right? The retracement is the slower, choppy move down. You are hunting for swing lows or trend lines that were created during that big push-up. You basically never want to look for liquidity within the current retracement itself.
And that brings us perfectly to premium versus discount pricing.
Honestly, just think of it like normal shopping. You don't want to buy an asset when it's super expensive, you want to buy it on sale. This rule literally forces us to sit on our hands, be patient, and wait until the price drops out of that expensive premium territory and falls heavily into a discount buying zone. But how do we actually measure that?
We measure it by using the 0.5 setting on your Fibonacci retracement tool. The unbreakable rule here is that price must pull back from its high and hit at least that 0.5 or 50% retracement mark. It absolutely has to cross that halfway point into discount pricing before you even think about considering a long position. If it only pulls back, say, 30%, you sit back and do absolutely nothing.
Section 4. Executing the perfect setup. Putting it together.
Okay, let's put the whole puzzle together into an actionable, highly profitable execution strategy. Here is your exact step-by-step entry protocol. You've found your 4-hour uptrend. The price is finally pulled back below that 0.5 Fibonacci level into your discount pricing zone. Step 1, wait for the price to actively sweep that critical liquidity low from the previous impulse move. Step 2, whatever you do, do not buy blindly. Watch on a lower time frame for a market structure shift, meaning that downward pullback finally breaks its own internal structure and starts pushing back up. Step 3, enter your trade on the newly formed demand zone that caused that upward shift.
Mechanically speaking, here is exactly how you manage your risk on this setup. You execute a buy stop order immediately when that market structure shift happens. And where does the stop loss go? And this is vital. You make sure your protective stop loss is tucked away safely below the absolute lowest point of that liquidity sweep. Think about it. Because the market just cleared out all the liquidity below that low, it essentially has no structural reason to go back down there anytime soon. Your stop is incredibly well protected.
But what about the profit target, right? Your primary target is pretty much always going to be the new higher high on that larger 4-hour chart. Based on where you managed to enter in that discount zone, you are aiming for a minimum risk-to-reward ratio of 1 to 1.5. So for every dollar you risk, you're pulling in $1.50. That keeps the math heavily in your favor over the long haul. And for the more advanced traders out there who really want to maximize their edge, you can actually scale in. Once that internal market structure officially shifts bullish and your first trade is running nicely in profit, you don't just have to sit back. You can execute secondary scale-in positions using this exact same liquidity logic on the smaller time frames. Wait for the next internal liquidity sweep, buy that dip, and target even bigger returns, like a 1 to 2 risk-to-reward ratio. So armed with everything in this explainer on market structure and liquidity, you now have the exact professional edge you need to go out and conquer those prop firm challenges. You know how to identify where the masses are trapped, wait for the discount, and strike precisely when the structure shifts. Which brings us to one final crucial question. Are you going to keep being the one providing liquidity for the big players, or are you finally ready to start trading it right alongside them? The choice is entirely up to you.